All right, all right. Welcome to Wall Street Jackboyz Game Plan Sunday. Today is July 7, 2019. We're actually going to take a look at the markets, what occurred over the past week, what's coming down the pipeline in the near future, and some setups that we can actually make some money coming up this week. Got a couple of different things we're going to touch bases on here, and then I'll go over some setups with you guys, and then I'll take some questions from you guys at the end. We'll try not to take up too much of your time. So the session should last about 30 to 45 minutes, hopefully. So let's get into it. So last week, we had a pretty short week in the markets. There was holiday. It was 4th of July, as we were just discussing, lots of booms and explosions going on, right? And so Independence Day was last week. We had a short week in the markets. And so the message for last Game Plan Sunday was try to get some quick money before Wednesday and Thursday. And then the markets resumed on Friday. So starting the week out, though, we did get some economic information from the ISM about manufacturing. We got the manufacturing numbers that was just basically showing a slowdown. It was showing a slowdown in manufacturing. And basically, what does that mean for us as traders? That means that, you can expect more slowdown. Before that came out, we also had a message that the 77% of companies were already reporting that they were going to miss their earnings. And you guys know that we are approaching earnings season coming up right now. So that's something to keep in mind. If the corporations are saying, hey, we're not going to hit our Wall Street estimations. So, they're already projecting that they're not going to do it. So when we take a look at some of the economic data, like the numbers from the ISM, we're looking at supplies from manufacturers. Just think about any goods that you have in your house. If you have a good, if you got this calculator and you're a manufacturer of this calculator, well, you got to get the supplies, the plastic and all this stuff here so that you can make this, these goods. So when we're combing through the economic data, what we're looking for is, to see if manufacturers are ordering more supplies or if they're ordering less supplies. What this means is, okay, if they're producing more goods, right? If they're producing more goods, then they're going to need more supplies. So it's not just they're producing, but they're producing and they're selling more. So the more you sell out of your inventory, you're going to need more supplies so you can keep on producing more. And so when we take a look at this data, it gives us a little insight into the future. We have some data that we look at that are leading indicators, and some of them are lagging indicators. And this is a leading indicator, kind of gives you a peek into the future, because you can say, okay, if the data is good, meaning that more companies, more manufacturers are ordering more supplies, then that means they're selling more, right? So what we're seeing right now is that those numbers are actually declining. That means manufacturers, they're not ordering as many supplies as they normally would, and they're hitting, some ultra low levels, which is showing, it's letting us know that, the economy's slowing down. We already know the economy's slowing down. We've been talking about this for a while. We're also projecting a recession as well. And so that's the name of the game, is, can the Feds stop the economy from going into a recession? That's what all of this is going to be about here for these next couple of weeks, what we're looking at. But what I'll do is, before we dive into the markets, let's just take a look here at our handy dandy yield curve. We got this on our website as well, but I want to show you guys, I actually make all of this from scratch. I man the data. Every day we do updates. So these are things that you guys get access to. I don't know what the other guys out there teaching. This is Wall Street Jackboyz style. So if you really want to know what's going on in the markets, how to make money in the stock market, we do this for real. And this is just not like some crazy sales pitch or something, crazy. Like, we do this for real. So either way, you guys are going to get this wisdom. All right. So this is wisdom here I'm showing you. So basically what we're looking at here is what our yield curve, our handy dandy yield curve. As you guys know from previous sessions, this thing's supposed to look like this. That's a healthy, normal distribution of the yields, okay? From short term all the way to long term. If you lend the government your money short term, then you get a smaller yield, okay? The longer you lend them your money, the greater risk you got that they may not pay you back, okay? So you're supposed to be able to make more money the longer it goes out. And when that does not look like that, then you go to a flat curve, you go to a flat yield all the way to a inverted yield. Now, the inverted yield curve is a number one indicator that there's a recession coming up ahead. Okay. So again, this is a leading indicator that's letting us know to expect a recession. Okay. Why? Because you're lending the government your money and you're getting less return less yield, okay, than if you did for the short term. So that's not right. So this is just something that's not right. This is from Friday, okay? And so this is where we are right now. Again, we're going to, continue to monitor this here. What we want to pay attention to is the 3 months versus the 10-year. And we do see that the 3 months has a higher yield, meaning that you'll get more money if you lend the government your money for 3 months versus 10 years. You only get a 2.4. Now, this is interesting because Thursday, I think it was Thursday. I want to say, no, not Thursday, but what was it? Tuesday before the markets had closed. This dropped beneath 2. Okay, and that's a key level. They don't want to see this go beneath 2. And so it's struggling here at the 2. And we're talking about the 10-year yield. Okay. And let me actually see if I can actually just show you guys that. If we go back on the 3rd, yeah, there we go. So if you go back on the 3rd, you can see it was 1.98. Okay. That's just really not good. Okay. The situation is getting worse. So the more that this thing continues to, go down that way, it's just showing that the economy itself is deteriorating. Okay. This is the yield curve. All right. So you guys may hear about it. We teach about this in our courses at Wallstreet Jackboyz. Not only do we teach you how to trade stocks, but we teach you about the market. We teach you everything you need to be successful, so you understand this stuff that I'm talking about. So if you don't know what I'm talking about, don't let it go over your head. Just make sure you subscribe, get the training. But right now, you're going to get the exposure of how we want to assess the markets. Okay, so I just want to show you guys that because this week coming up, we have the Fed's FOMC release that's going to be on Wednesday. The stock market is going to be watching this. This is going to be a major event. It's going to be like one of those Super Bowl events, right? And so depending on the news that come out of that meeting on Wednesday, bonds are going to either move up or they're going to move down. Okay. But let me actually, to give you a little more context, I'm going to give you a different view on this. Okay. A little different view. Sometimes I like to look at them in different views. That's why I got 2 different views here. The gray line is 3 months. Blue line is a 10-year. Okay. The 10-year is supposed to trade above the gray line. So the blue line is supposed to trade above the gray line. This is where it's supposed to be. And the further apart they are, the healthier the economy is. As they get close together, as they squinch in, the worse the economy gets. If they invert, then you're looking at a recession. So again, this is the first inversion there. Then we have this inversion here. It's a really long inversion, okay? And every time it does this in history, okay, we go into a recession, and we're still in this zone. You see the blue line is trading under the gray line. And as long as that continues, you're going to be in for a long ride. You're going to be in for a rude awakening. So I'm just giving you a glimpse into the future. This is what it is. I can go back. We can go back how many years you want to go. We got all the data to show and prove what we're talking about. This is 2007. See the blue line above the gray line? Okay, 2008, that's where you got the recession. The Feds end up dropping those rates to 0, trying to save the economy. It's not the presidents, it's the Feds. Remember, the Feds control this thing. Same thing back in year 2000. You see the inversion, blue line above the gray. You had that 2000 recession, right? Then the Feds start to drop those rates down, okay? So anyhow, we got lots of data all the way back, You can just go and, check that. So this tool is available for you guys to use and, just check it out. It's pretty cool. But just remember, we're in a slowdown economy because the technicals tell us so. Also, we just had the ISM numbers are showing us slowdown as well. Now, it's interesting because all week you guys hear stock market hitting new highs, stock market, this, that, and the third. Well, the stock market is not the economy. The stock market is one indicator of the economy. Okay. It's only one indicator. It's lots of other things that we look at when we're looking at the whole of the economy. But because we're traders, we're here trying to navigate the markets and get this money. So we try to pay attention to things that are relevant to us making money in the stock market. So there's lots of data that's going on. We want to pay attention to the data that's going to impact the markets the most. Okay. So let's just take a look here at the S&P 500. This is big view. Okay. S&P 500 is doing phenomenal. Okay. You just see we hit that new high, 3,000. Okay. That's a new record there. Okay. And then we came back down underneath the 3,000 levels. Right now, currently we're at the 29.92. Again, the futures are trading right now, so you guys can see everything is looking pretty good, right? Everything is looking pretty green right now as far as that goes. If I dial in here, Dial in means I'm going to actually zoom in on a smaller time frame, so we get some little more nooks and crannies in this thing. We can see that after the markets hit this 3,000 target on our Fibonacci level, this 161.8 retracement here, after it tagged that, we can see that it struggles at that line. Okay, so this line, we can just see the behavior. The behavior is that it struggled there, right? You can just see it. Let me just draw it in here. It pierced through, but it never cleared. Came back to its mean, came up and traded sideways, never cleared, never cleared, never cleared. And then we got a sell trigger that says short. Boom, popped down. It never cleared. So this is letting us know that, hey, this is a key resistance level. So this is a good area to pay attention to, because we see how the price action behaves towards this level. Now, remember, this line is not here. Well, this is something that we put in here. And this is through the Fibonacci tool that we use. We have a whole class that teach you how to use the Fibonacci tool the way that the masters use it. OK, so anyhow, this is the tool. Again, like this green line, you see, that stuff is not in the markets. This is stuff that we actually highlight with the tools that we have that lets us see these invisible levels. OK, so you see these invisible levels. You see the price action moving up and behaving against it. So that's how we know it's valid. We know that it's valid because we see price action behave to it. Without this, you would not know this. OK, so either way, we started to come back down. It did a pretty down day there, and then came back up, and it's just hovering right here. And right now, that's where it's still at right now. Okay, so this can go either way. Now, a lot of this is going to really depend on the information that we get from the Feds on Wednesday. Okay, so what the markets is wanting to do, the markets want a stimulus, the stock market, that is. Okay, so the Feds create the stimulus by cutting the interest rates. So what we're looking at is in the Fed's meeting minutes report that's going to be released on Wednesday. The Feds don't actually go into decision with cutting interest rates to the end of the month. So the last week of this month, that's another meeting that's going to be very highly anticipated. There's going to be a lot of movement. I don't know if it's going to be up or down, but it depends on what the Feds decide to do. But what we're going to learn is some insight from the Fed's last meetings, because again, they had these meetings behind closed doors and then they release it later. So we're going to get the inside scoop now. Okay, so it's after the fact. We're going to find out, how are the Feds assessing the situation? Are they going to cut the interest rates, or are they not feeling moved to do that? And depending on what they do, they're in a really tough situation, because if they don't cut the interest rates, then the market is just going to sell off. Okay, so we're going to see a big drop in the markets. It's going to go crazy if they are not saying anything accommodative towards that. Okay, because again, they want the interest rates to be really low. You hear Trump always talking about Obama, how Obama had a cheap rates. He's telling the truth about it. He has 0% interest rates, and so you can make a lot of money with 0% interest rates. And he wanting to get those levels. He's at 2.5 right now. He's not happy about that. And so, it's a lot of talk about him firing Jay Powell. He ain't firing nobody. He's just talking because he's upset. But the markets is also on his side. So the markets are saying, hey, we need them cuts. Okay, everything is slowing down. As you guys see, everything is slowing down. The Feds don't come and help these guys out, help the stock market out. It's going to hit the fan. So that's what we're going to be looking for details in that report on Wednesday. So you really don't want to go into aggressive before Wednesday. If you throw on a couple of trades, 1 or 2, don't go throw a whole bunch of trades on, because we don't know the outcome of how the market's going to react to the information in that report. And I believe the report comes out around like 2 p.m. in the afternoon. So just, put that on your calendar around 2 p.m. If you have any trades on, you might want to take your profits before that time comes, because it's a binary event. It either goes up or down. We don't know the direction. And so we're trying to figure out, are the Feds looking to accommodate the markets, or do they feel, hey, the economy is super strong. Why do we need to give them a stimulus? You see the stock market hitting all-time highs. Why do you need a stimulus? So these are warning signs that you guys should see as well, where you have a stock market hitting all-time highs. Why do they need help, interference from the Fed to help stimulate it? You have to kind of think on these levels. There's a lot of chess being played. And so why would this super strong stock market need help from the Fed? That lets you know it's a lot of weakness in the economy. The yield rates, these guys, they know it. The yield curve inversion, all signs point to a recession. But what they want to try to do is stop that And the only way they can do it is trying to cut interest rates. But the problem is they don't have much stimulus to give the economy. They only got 2.5, interest rates to give to drop it down to zero. And so they definitely don't want to go into the negative territory, because then it's really going to be really bad on the U.S. currency and everything. So on the whole financial system, it's not going to be good, and you don't want to see them do that. So anyway, just play it one step at a time. Just keep in mind that that's what's going on right now. Now, this 3,000 target is still on deck. Okay, they haven't cleared it yet. We tested it, but we didn't clear it yet. So I wouldn't be surprised if we possibly come up to this target, but I'm not seeing where that we're going to actually clear it. Okay, I'm actually seeing that I'm actually gearing more towards the downside, and I'll show you guys why I'm gearing more to the downside. I'm looking actually more to the short side. So if you look here, I'll show you guys my Ready Aim Fire tool. You see here the market is overbought. Okay, let me just go back to yellow here. Okay, now the overbought territory, oversold territory, as we've seen in the past couple of years, it can linger in these zones, but you don't want to be a buyer at these tops. Okay? You don't want to be a buyer at these tops. It's telling you to short. Our signal is saying go to the short side. Okay, now right now might not be the time, but I don't really want to be a buyer at these tops. It's extended. The normal range, you want to see it moving within this range. Okay, that gives you room to the upside and room to the downside. But when you're up to the top, you're not going to be able to go too much further. Okay, that's the way that it normally works here in the markets. We are seeing momentum slowing down with the dark blue. That's letting us know that we're decreasing. Light blue means we're increasing. So we're seeing decreasing here. Now my trend is still up, so anything can go. Okay. And what I'm seeing here, we'll go to the fear indicator, which is the VIX. All right, so that was my MTF tool that was just letting me know I had some bearish zones there. I want to rattle you guys. I got a lot of tools and indicators behind the scenes here. And anyway, I want to take a look at the VIX, because this is what brings me to my decision here. In fact, let me actually give you a different view of this VIX. If I can get this thing to load up for us. What's good, Rashad? What's good, Lucretia? What's good, Anthony? What's good, Wes? I see you guys. What's happening? What's happening? All right, cool. So looking at the VIX here, what you want to pay attention to is the normal distribution. Okay, so that's, this is the normal distribution. All right, this is the way it's supposed to normally move within these ranges. All right, anything within this range is normal. Okay, that's normal. Anything that pops outside this range is abnormal. Okay, abnormal. Okay, and when it pops above these ranges, these are extremes. Okay, so when these things get really extreme, they get so extended that they end up snapping back to opposite direction, like a rubber band. Just think about a rubber band. Okay, if we take a look in the past, okay, remember those little green lines. This is our bounds. Okay, we want it to move within these bounds. Anything that's going outside these bounds is extreme, and extreme levels pop back. So take a look here. When we pierced those boundaries, we saw that it had a strong upside. Now remember, the VIX is the fear indicator. Okay, fear. So when this thing goes up, when it goes up, the markets go down. Okay, so when the fear goes up, equities, which is the stock market, stocks go down. Okay, and when this thing goes down, stock market goes up. So just remember, stocks go the opposite direction. So if you see, fear goes up, stocks go down. Fear goes down, stocks go up. All right. So when we're actually taking a look at this thing here, look in the past, we saw that it extended here. All right. So this means that the stocks were too bullish. They were over bullish. Okay. So they get over bullish, then you get that reversal that happens. And then the fear comes back in. Okay. So fear comes back in, markets go down. All right. So you see when the fear got stupid, crazy, dumb last year, lots of volatility last year. This is what set October time frame. This when gold started making this run up. Okay. And then this is December. All right. That was that December, right? That's a lot of fear. This is like super abnormal. A lot of fear. And we saw when you look at these side by side, you can see this goes up and the market goes all the way down. That was December. So almost went into a recession December because of that. But since then, you see this going down, and all of this is going down because the Feds just said, hey, we ain't going to do nothing. We're going to chill. We're going to chill. We're going to relax. We're not going to do anything. We're just going to let the markets, run its natural course or whatever. And so the stock market has been hitting all these crazy new highs because the Feds at every meeting, they say, oh, we're not going to do anything. We're not going to do anything. That is a stimulus to the market. The reason why this went up like this because the Feds raised the interest rates. They raised them back in December. Remember that? Raised interest rates. Markets was not feeling it. They said, Jay Powell, you got to pay for this, buddy. It costs a business too much dealing with you. Trump started calling them out everything. So the Fed, it went up. So come 2019, the Feds was like, well, we're just going to sit here and we're going to watch the economy, watch the development. We're not going to do anything. Now, the markets didn't get a rate cut, but this is pretty much equivalent to a rate cut for the markets because it's like, as long as the Feds don't interfere, we're going to go pump it up. Okay. Okay, I got you, Richard. Yeah, so so with them not doing anything, the VIX has been coming down. It's been going to sleep on us, right? No fear. Okay, got up a little bit in May this year, right? Gold started jumping up crazy high. Now you guys remember May was the worst month of 2019. That was in our Game Plan Sunday from I think two weeks ago, right? So if you see the VIX going crazy up high, it went to those out of bounds levels. Okay. And that was May. All right. If you see down here, that's May. The worst month of 2019 is May. You can see it right here in the VIX. But it hit those extremes and then it popped back. Okay. And so, June, you had a pretty good June month. We had job numbers that just came out. Right. The job numbers came out, talking about 224,000 jobs added. I showed you guys in the group, the private group on Facebook, how the job numbers, you really got to kind of understand how they, come up with these indicators. I'm not going to go into all the full details, but it's not all that it seems. It's certain things that they don't include in the job numbers when they release it. Like they don't include military, they don't include people in prison, they don't include, people in some nursing homes and things like that. And it's not perfect, but it's a reliable indicator. But for the most part, certain things that's in the economy that I showed you guys that when it's showing these crazy job numbers going super high, but you're in a weak economy, a lot of that is not coming from just all these jobs created. It's one person working 2 jobs or 3. Some people working 3 jobs. So the way they're looking at it, okay, if you have a lot of individuals like this individual who's working multiple jobs, and that data, every time you apply and you get a new job, is just considered a new job added to the economy. It don't mean more people are actually working, okay? It don't mean more people are working. So you just got to understand, how this stuff works when you get the news and then how the markets react to it, right? Some stuff is fluff, some stuff is not. Some stuff is propaganda, some stuff is not. Anyway, so with all those jobs, coming out, it was looking like a rebound. You got to remember May was terrible. We had like 75,000. It was a super short, but over the long term, jobs are not as much as they should be. Okay. That's because we know that the economy is slowing down. All right. We know that we're at the end of this business cycle. They can't keep it going forever. You cannot keep it going forever. It's not healthy. You got to let it run its natural course. Either way, what I want to get to is that if Uncle Warren Buffett, he always says you buy when they are fearful. You sell when they are greedy. This is another way to look at this indicator here. Okay. Remember, when this goes up means fear. Okay. When it goes down, that means that they are getting greedy. Okay. And when they get extra greedy is when they go out of bounds. When they get extra greedy, Uncle Warren Buffett says sell. Okay. So remember, out of bounds, Uncle Warren Buffett says sell when they get greedy. I said extra greedy. Okay. So Wall Street Jackboyz say they get extra greedy. That's when we sell. Okay. No disrespect to Uncle Warren Buffett. He the man. Okay. But if you look, when the fear came in, all this extreme fear, that was the time to buy, actually. So what you saw is all of the people, you know, everybody who knows what's going on, they started buying. And so you start to see the stock market rise. They're just buying, right? Because you buy when they are fearful, then you sell out when they are greedy. Just like here, sell when they're greedy. Sell when they're greedy. We look here, sell when they are greedy. And where are we at today? Look at that. Does that look like they're fearful, or does that look like they are greedy? You guys know the answer to that? All right. So what I'm looking at is greed. Okay. Extra greed right here at the top. This is beyond the out of bounds level. We see this candlestick here. I'm going to zoom in so you can see it. It's extended beyond the boundary. Okay. So on Friday, we saw it snap down and it came back up. It's closing up. So when we see that snap and it comes back up, what we've seen every time in the past, snap, rise. Okay. That's all we're looking at. So we got a snap here. So my projection here is a rise. I don't know how far it's going to rise, but just keep in mind that this is, you know, my idea for what we see in here. And we're probably like the most technical traders on Facebook, okay? Or any other platform. Probably like the most technical traders. You know how to read the charts. I'm showing you guys the charts. This is all technical information. But trading is a little more than just technicals. You have to have other insights. Okay? So that's what we're showing here. So let me know if you guys follow what I'm saying. If you see what I'm saying, okay? Out of bounds. Look at every time it goes out of bounds. What does the markets do? They do like Uncle Warren Buffett says, okay? You sell. When you sell, that fear comes in. That fear comes in. That fear comes in, okay? It's out of bounds again. So my projection is fear is going to come back in. The market is too relaxed, they're too happy. You know, stock market hit those new highs. And so because this is what we see here in the VIX. Now, I mean, again, I could be wrong. It can continue to go further down, but we're already seeing it start to reverse. We saw it snap and then it came back and close higher. So again, this thing goes high just like we see it, you know, like how we saw it do every time in the past. I'm just projecting that it's going to go up. Now, if the fear is coming in the markets, then I want to get short. Okay. I mean, that's just how I want to play it. Okay. So key things to remember before we go over some setups here. This week, we got more economic, data that's coming out. We got the inflation numbers that's coming out on Thursday. Okay. That's going to be a big deal in the markets because the Fed, they use their interest rates based off of controlling inflation. And Wall Street is expecting inflation to have risen to 2%, maybe even a little more. If inflation is rising, then that's just, this again, they're just gauging if it's healthy, helpful or harmful. And so that's what they want to look at. They want to see how those inflation numbers are going to come out. And so just remember that's on Thursday. But Wednesday, Fed's minutes meetings is going to be released. We're going to see the markets move based off of that. And I don't know what way the markets are going to move, but they're going to move. So based on what I just showed you guys, thinking about getting some short exposure here. Let me see. I want to show you guys the voodoo lines here. What I'll do is, excuse me, I don't want to confuse you guys with that. We'll take it back here. Okay. We got all kind of indicators, man. We got lots of indicators. You just got to know how to use your tools. You don't need everything that you see here. You just need, 2 to 3 good tools that serve you well. That's it. So master what you know. But again, we teach you guys how to use these tools that you see here. So anyhow, if we're looking at, this is when I actually looked at this chart before in the past, I kind of kept this one on for my Fibonacci, but it behaved exactly where we needed for it to do. Went through all those levels, super bearish. But what I'm seeing in here is that it did, bounce off this floor level here. And then they came up to the 50 moving average, which acts as a level of resistance. Okay, so this is a counter trend trade kind of. Actually, it's not a counter trend trade because we actually the big trend is actually down. But it's in this little uptrend that is in right now. I want to play it to the counter side. I want to play it to the short side here. And that's because this 50 moving average is waving up above. We saw that it struggled with trying to clear. It never cleared. And then it's starting to snap through. Okay. I do have short triggers that says, hey, short here. Also, in these levels, we're extended. And the fast stochastic is showing us that it's going down. Momentum is going down. We also see momentum going down here as well. So I wouldn't mind getting into some short exposure here on a 3M company. Okay. And then I'll also take a look at this one here, WDC. And this one right here is a little trickier here because it has just broken above its 200 moving average, but we are seeing that it's overbought. That means they bought it up. They bid the price up too high. It's too high at these levels. I am seeing a little momentum shift here. I don't have any cooperation with these two indicators just yet, so it may be a little early to the party. However, I will be looking at this one for some short exposure as well. So I'm kind of looking forward to kind of play kind of like this move back here in the past. It kind of went above that 200. We got a sell trigger. It wasn't able to sustain. We're back at this level again. This is like another test. And I'm banking that it's going to actually do that number. Okay, so looking into getting some short positions there. Okay. Now, again, if the Feds are accommodative to markets or sound like they're remotely accommodative, on Wednesday, then we may see the market. We'll see the markets uptick where the markets will go up. So for some bullish ideas for the long side, I do like Verizon. It's a little tricky here on Verizon, but this is why I like Verizon to the long side. And it's because, for one, the entire sector itself, the communication sector, has actually been doing really good. It's actually snapped back. It's actually doing pretty good right now. And so remember, Verizon is a key component of that sector, which is heavily weighted in there. And so it's going to, if that sector continues to drive up, then this is probably one of the names that's going to pick it up here. But what we're seeing here is, we caught a buy trigger here. We caught a buy trigger here. We got some momentum shifting there. We got a squeeze here. That's one of our number one setups that we use. So that, because that squeeze is there, it's letting us know that this thing is gonna blow. Okay, and we don't know if it's gonna blow north or south, but looking at the momentum and with the trend and where everything is shifting, everything is telling us north. So just looking at the technicals, that's how we read it. It's telling us north. Now the key thing to remember is that this 618 Fibonacci level is a key level. Okay, and as we see in the past, this thing struggles with clearing this level. So the key to this is actually we want to see if this is going to clear this level. It has to clear this level. Okay, if we clear this level, then we want to get in, take it to the north side. Okay, we want to take it to the north side. So you want to get in there. So basically how you do it, you just, again, you go on your intraday charts, a smaller time frame. You see we're sitting on top of it right now, but we want to see it uplift off of this level. Okay, because it can fall down. We don't know. Okay, if it falls down and it catches on this level and it continues to trend up, then we'll catch it again as long as it is above the 618 retracement. So we'll see how it behaves. We want to catch it above this level. That's a good buy trigger for me. Okay, then we ride it north. All right, so again, you can just take a look at that on the 5-minute chart when you're ready to enter. Now volatility is low on here, so if you're looking at the options chain here, if we look at the options chain here, you can see the calls are not expensive on this one here. So you probably want to go into a buy call strategy on this one here, or you can do a debit. But if you're looking at like the 91 deltas, it's about $330. Okay. And it's for, it's $330. That's to your total risk. You have unlimited profit potential. Okay. Or you can do the Delta 60s. Okay. It's only $151, which isn't bad. Okay. So it's $151. That's the most that you can actually lose in this trade. And so let me actually see how we would do it. You would just go into a buy call. We'll just analyze the trade itself. Okay. So we just basically what we see here is that we have, this is a good thing about options. So if you guys don't know nothing about options is different from stocks. But the cool thing is that your maximum profit and your maximum loss before you enter and exit a trade. And this thing here is telling us, again, we already know 153. If you look at this little blue numbers down here, it says negative $153. So if this thing does not go north as we are projecting, if it goes down, then we're going to lose money along the way. Okay. So you'll see that the max that you can lose, and again, that's if this stock drops all these points, is $153. That's the max you can lose no matter what. Okay. Now, the most that you can gain, if this goes the way we're saying it is, okay, if you just see we're at like $58, just $2 here, you'll make $300. If this stock moves by $2, it goes from 58 to 60, basically, you make about $300. Okay. Now the sky's the limit. It tells you $700, $800. Just depends. Depends on, how well this thing goes up. So that's a lot of money. You're risking only $150 to make unlimited profit potential. Okay. So that's the beauty about options. That's why you guys should learn to trade options. Options is pretty awesome. It is not the easiest thing to learn. And that's why we have training to teach you this stuff. Okay. So again, if you guys don't have the training, go to wallstreetjackboyz.com. Make sure you register, make sure you get the training, and then make sure you join a group with myself and all your colleagues here so they can help you along the way to understand how this stuff works. Okay. So if you guys got any questions, just let me know. But again, what we're looking at here is just a risk profile. It lets us know before we ever put any capital to risk. Okay. It lets us know what to expect in advance, maximum loss, maximum profit, which allows you to manage this trade. Okay, if you say, I don't want to take more than a 50% loss, well, that's about $75, right? So if this trade drops down to about $56, it don't matter what's going on. You need to make sure that you exit at around, if the stock itself goes to $56, then your options trade itself, you'll lose about $75. Are you willing to risk $75 to make $700, $800? I mean, realistically, yeah, you can definitely hit these numbers. Okay. It'll tell you the risk profile, tell you that it's unlimited, but you can expect to hit, $500, $600 on this, and this trade can do what it need to do this week. We're not talking about waiting years. We're talking about a couple of days. Okay. But if you just want to make, your 50%, again, $300, that's good enough for me. If I hit $300 here today, tomorrow I'm out. That's enough. Don't get greedy. Uncle Warren Buffett told you that. Okay. All right. So that's a long idea. Okay. So I showed you what happens if you're wrong. I showed you what happened if you're right. You got to manage your own trade. So understand that. It's every man for himself. Another situation, another potential setup here would be Nike to the long side possible. Now the squeeze on here is already fired long. It really didn't give us much. It really didn't give us much out of it, but it definitely has potential to move higher. It's not oversold. It's not overbought. So it's got wiggle room here. Okay, you guys can see it's within these levels. Here's the squeeze. The squeeze did fire off one clean dot. We have upwards in the momentum and the trends. The buy trigger that we had was back here. So really you should have already been in this trade and probably should be out of it right about now. But it still has some more potential. And what I'm looking at here is a pattern, basically. This is an inverse head and shoulders pattern. And so this setup here, the way it works, it kind of does that, pattern. Okay. So we do have a potential, up to about $90 on Nike. But again, manage your risk. This thing goes north. If I get 50% off of it, it depends. Like if there's a lot of volatility, I may take out at 30%. So just manage your risk. You got your trading plan. If volatility is in the market, again, we just see in the futures they were just positive. Now you see them starting to turn negative already. Okay, already turned negative. So again, we get that volatility in there. I'm taking 30% and I'm good. 30% is profit. Okay. So that is another long idea that I am going to be gauging in Nike. Let me see. And then utilities. Now, utilities have actually been doing pretty good. So just keep in mind if the market is going to go south, then there's going to be a flight to safety. All right. A flight to quality, where you normally see gold, bonds, or utilities that go up. The fact that gold is a little extended, and I think it's taking a breather. Bonds is also doing the same thing, but utility are not. And so if there's going to be a flight to safety, I'm pretty much looking at, smart money plowing into utilities. Now, utilities are a little expensive for them, but we do have some wiggle room with utilities, whereas in bonds and golds, we don't really have much wiggle room. So we see here, we do have a buy trigger here. We do have a little squeeze here, but this is really not doing anything for us right now. But we have a buy trigger here as well. And so what I would like to see, well, I don't know if I want to see it or not, but again, if that fear comes into the market, I have high probability that, money's going to plow into utilities and will go up in utilities. And so you can either play this whole sector, XLU itself. There's another name that drives utility that's within the basket itself, Nextera Energy. So we saw the basket itself is in a squeeze, and then we have the name that's inside the basket that's in a squeeze as well. So this squeeze fires off, it goes out into the big picture. And so now these are not as cheap, but if you want to get some exposure to the short side of the market, but you want to play it long, again, if it's something that's, a proxy like this, you play it to the long side, because as this goes up, markets normally go down. So either way, this is what I'm liking right now as well. I'm looking at the squeeze here, and potential fire off to about 213 is what I'm looking at here with our Fibonacci targets. So 211 first target, 213 is the second target at the top. Okay. And that's what I see here. These are some ideas that you guys can take a look at and manage. For our new traders, you can put these on yourself in your trading account, in your paper account, and see how they work out for you. Do you guys have any questions for me? Any questions for me that we can take care of real quick? While I'm taking care of your questions, if you guys have any setups that you want to take a look at, we'll do an analysis on those setups before we bring the session to a close. So yeah, but I definitely want to appreciate you guys for showing up, especially on the Facebook side. You guys are showing up, and I appreciate it. You're sharing the content, hitting those like buttons. Appreciate it. Appreciate it. And make sure y'all check out the articles, okay? Make sure you check out those articles. Lots of free wisdom that's in there, and lots of research and stuff goes into those articles. So make sure you take a look at those. Get on the newsletter, subscribe to the newsletter so that you can actually take advantage of that. I'll try to put the link on the Facebook side so you guys can get that, so you can subscribe, so you get it right to your inbox whenever we release new information. And we have some goodies that we release as well. Ron, where you at? Ron, you still in here? You got any setups you want to take a look at? Wes, you got any setups you want to take a look at? Mark, got any setups? Lucretia, who else we have in here? Terry, Keith, anybody have any setups, any concerns? Okay. All right. Well, Twilio. Okay, good. Yeah, I was taking a look at Twilio before, Mark. I'm glad you brought that up. So Twilio is, this is an interesting one as well. So you good, homie? Okay, good. That's what's up. Mark, I actually, yep, I'm checking out Twilio right now. This is an interesting one too. As you see, it's already charted this one here. Now Twilio was actually giving us a buy trigger here. We got a buy trigger in Twilio. Okay. So it hit those outer ranges, you know, it's oversold. They sold too much of it. And now it's time to buy it. Okay. We're seeing, you know, momentum shifting to the north side. We did get the bleeding in the squeeze, but it's in the squeeze. Okay. But because these other triggers, these other tools over here are going north, then we may see this turn around like this turn from the red to the yellow. Okay. From the red to the yellow. So this may go from the red to the yellow. And then, you know, the trend is not showing us right now, but that will pick up if the move follows through. We do have a buy trigger here. So if I'm going to play Twilio, I like to play it to the north side to about 150. That's a 10-point move. Now, I'm not too sure what the market is saying. Let me see. 20 points. Okay, so if you're looking at the 40-day expirations, you're looking at about 20 points in Twilio. 20 points. The market is telling us this thing is going to move 20 points plus or 20 points negative. So that's your range. You got from 120 to 160 basically is where the market makers is telling us that this stock is going to trade. So that's just giving you your risk profile basically. Okay. It's already letting you know your risk in advance. So you say 120 is down here, 160 is at the top. That's close enough to my 161 extension on the Fibonacci, right? That's close enough to that. Okay, but that's within 40 days. Okay. If this thing hit 150, I'm out, P. I'm done. You know, I'm taking mine and I'm running. Okay. I'm running off on the plug, man. Got to know how to run off on the plug with the bag, because if you don't get that bag, you might not hit this level. To sell off on you, you don't make the money. So these targets are here to let us know when to get in and when to get out. That target says, hey, get out here. Now, if you're carrying a couple contracts, you could take off half of your positions at this level and see if you can ride out to capture the next half. Okay. You know, so at least you can capture some profits. All right. I got one more. I was looking at Intel SAT. Intel and SNX. Is this what you're talking about, Intel? This is what you're talking about, Ron? Intel? It's been a while since I played Intel. Yeah. Yeah, I don't know if this is the one you're playing right here, Ron. Again, this one, I don't have a sell trigger on here. But I do see that the momentum is starting to shift downwards. It does have this major level of resistance right here with all the moving averages there. I would actually like to look at that to the short side, to be honest. So that is Intel to the short side. And then you said you had SNX. Let's see what this one is, Synex. So this is a good bullish chart here. We'll take this swing high to this swing low. We have some levels here. And again, the chart itself is bullish. So and we have some room. We have some room up ahead. Okay, so it's not overbought. So it has potential to move higher. I would like to play it to the north side. Now I don't have a catalyst that can actually push it up higher. I don't have a squeeze or nothing like that. But you know, according to our Fibonacci assessment, we have a target to the strong side is, you know, $115 north. But I don't see any catalyst that can push us there, but it can still get us there to about 115. So I do like that north, but keep in mind, it is struggling at our 618 retracement. So, which is the, you know, $100 mark. And so what I will actually do is basically just see if that's going to clear those levels, go on the intraday chart. Okay, on the intraday chart. And you may get some pullback here. You may get some pullback to about this level. And if you see it strengthen up again, get in on that level, on that trigger to ride it north. So 104, this is the next target on here. So again, I like that to the north side. Make sure to get you the replay once you edit it and cut everything up. You guys get the email. So if you're on a newsletter, if you're a subscriber, then you'll get the playbacks that we do on these. It's important that you guys show up live so you can ask your questions, so you can see everything that we have here. But that's my assessment over the markets. We took a macro view. We took a big look at the markets, and then we dialed in. We took a look at some setups. You guys have been informed on events that's coming in the markets this week that will be shaking up the markets, either good or bad. That's the FOMC meeting on Wednesday, and then the CPI numbers coming out on Thursday. So keep your eyes on those. With that being said, I'm going to go ahead and cut the session short, but I appreciate you guys for showing up. Y'all have a great end of your weekend and a start to the new trading week. Peace.